Welcome to Tech Blueprint, a window that lets you know the latest technology news in the world. In 2025, against the backdrop of profound restructuring in the global semiconductor industry, the US's previously implemented technology blockades and export restrictions not only caused US chip giants, once heavily reliant on the Chinese market, to face plummeting revenues and idle production capacity, but also sent their stock prices to record lows. Meanwhile, China seized the opportunity to accelerate domestic chip development and advance its semiconductor industry towards independence. China's recent adjustments to its trillion-yuan chip orders sent a clear signal to the world: China is no longer a market to be relied upon in the global semiconductor industry, but a rising technological power. Faced with this change, can US chip companies withstand the pressure? Over the past 10 months, the US semiconductor industry has experienced unprecedented market volatility and capital drawdowns. Data shows that the total market value of leading US chip companies has evaporated by nearly $1.4 trillion, a figure comparable to the annual GDP of a moderately developed country. This massive asset reduction has caused investor panic and a continued decline in market confidence. The continuous decline in stock prices not only reflects the decline in corporate profitability, but also directly constrains their future R&D investment and capacity expansion plans. The stock prices of some chip giants, once considered cornerstones of the industry, have even plummeted to 16-year lows, a decline rarely seen before. Companies are also facing significant pressure on revenue. One leading US chip company saw its quarterly revenue plummet 35% due to a sharp drop in Chinese orders. To alleviate the pressure, it was forced to initiate layoffs and restructure its internal structure. The departure of senior technical staff and the reduction of its R&D team further weakened the company's long-term competitiveness. The difficulties facing production capacity are even more pronounced. Chip factories that once operated 24/7 to meet Chinese orders are now idle due to a lack of buyers. Millions of dollars worth of chips are piled up in warehouses, facing the dual risks of moisture and depreciation due to technological advancements. The Chinese market once contributed approximately 40% of US chip companies' revenue. Without this core market, companies are facing difficulties with cash flow, capacity utilization, and inventory management. Faced with the loss of orders from the Chinese market, US chip companies have attempted to fill the gap by expanding into other international markets, but the reality has far exceeded expectations. Growth in European market demand is limited, and annual market expansion is insufficient to support the idle production capacity of US companies. While the Southeast Asian market is experiencing growth, it is relatively small, with limited purchasing power. Demand for mid- and low-end chips is primarily focused on demand, making it less compatible with the high-end chip market where US companies excel. Even in emerging sectors like automotive and IoT chips, US companies face the dual challenges of fierce competition and low profit margins. These sectors are not only squeezed by domestic, Japanese, and Korean companies, but also require significant upfront investment in technological upgrades and capacity adaptation, making it difficult to generate stable returns in the short term. Faced with these multiple pressures, US semiconductor companies are forced to reassess their global strategic layout, but finding a new growth point to replace the Chinese market remains elusive in the short term, exposing the global semiconductor industry's heavy dependence on the Chinese market. China's position in the global semiconductor industry has long transcended being merely the largest consumer. Over the past decade, China has not only been the world's most demanding market for chips, but also a core application scenario for high-performance chips, such as those for data center chips, smartphone chips, and high-end consumer electronics. American and Western semiconductor companies have long relied on Chinese orders to maintain revenue and technological advancement. Losing orders from the Chinese market not only means short-term economic losses, but also disrupts companies' capacity planning and technological R&D. It is noteworthy that China is not passively responding to external restrictions, but is actively accelerating the process of semiconductor industry independence. Currently, China has achieved multidimensional breakthroughs in semiconductor manufacturing technology, from mature 28 nanometers processes to advanced 14 nanometers processes, with production capacity continuously increasing. This not only gradually meets domestic market demand, but also begins to reshape the competitive landscape of the global chip industry. The increase in domestic chip supply directly reduces dependence on high-end US chips, laying the foundation for the integrity and risk resilience of China's technology industry chain. Domestic companies' R&D investment demonstrates their determination. BYD has established an independent semiconductor department to focus on automotive-grade chips, and XPeng Motors has invested heavily in the R&D of specialized autonomous driving chips. These actions not only demonstrate the strength of Chinese companies in achieving independent development of key technologies, but also enable China to rapidly catch up in cutting-edge fields such as AI chips, autonomous driving chips, and high-performance computing chips. In some areas, China has already established the ability to compete with leading international companies. The US blockade of China's semiconductor technology, originally intended to curb China's technological development, has unexpectedly become a catalyst for China's independent innovation. The global semiconductor industry is now entering a new phase fraught with uncertainty. Competition between China and the US in key chip technologies is intensifying. China has already made the leap from following to catching up in certain niche areas, even demonstrating leading potential in areas like AI chips and low-power chips. The core of this shift lies in the independence logic behind China's adjustments to its trillion-yuan chip orders. China is no longer reliant on a single country for technology supply, but is instead building a diversified supply chain through domestic R&D and global collaboration, such as with European and Southeast Asian companies. Meanwhile, US semiconductor companies will face the long-term pain of losing the Chinese market and reassess the potential backlash from technology blockades. In the future, the global semiconductor industry will no longer be dominated by a single country, but will instead embrace multipolar competition and diversified collaboration. This presents both challenges and opportunities for all participants. Only by mastering core technologies, adapting to changing market demands, and abandoning the mindset of technological hegemony, can they seize the initiative in this industry's reshaping. This time, China's dual-wheel drive of auto adjustment and independent research and development has not only demonstrated to the world its determination for technological independence, but also promoted the development of the global semiconductor industry in a fairer and more resilient direction.